So welcome guys. So we had completed all the chapters covering all the illustrations and concepts in the management accounting. Now going forward we will be solving some of the problems, especially the practical problems which may be expected in the multiple choices or some 5 to 6 marks questions. So we will be solving one by one from every chapter. We will be covering all the important aspects which may be asked in the examination. So we'll start with the budget and budgetary control. So first we'll go with the multiple choice question first. So the question says that production at 60% activity is 600 units. At 100 it will be 1000 units. Obviously, no. If flexible budget needs to be calculated at 80% activity, what is the units produced? It's simple question. So for 60% it is 600. So for 60% it is 600. No, so we have to calculate for 80%. So 80% how much? So just cross multiply, you will get 800. So 800 is the answer for this. So simple question. At 60% they are giving 600 units. At 80% what is the number of units? So this we have learnt in the flexible budget concept. Please do remember that. Now this is one important question. Now given production activity 600 units at 60% capacity, the number of units is 600 units. Material cost is 50, labor is 20, direct expense is 5 rupees, and factory overhead is 20,000. 60% is variable, and admin expenses rupees 15,000, and in that 60% is fixed. Okay. Now what will be the total cost per unit of at production at 80% capacity? So we have to find the production cost for 80% capacity. First of all, the number of units would be 800 as per the previous question concept. So at 60% it is 600 units, at 80% it will be definitely 800 units. First we will calculate the material cost. So material cost is 50. Okay, I will write here only material, labor, direct expenses. No, we'll write in the separate sheet itself, so you can make note of. So second one, so first I'll write direct material, next we have direct labor, then we have direct expenses. So we'll see what is the amount given here. Okay, so the material cost is 50 per unit into 800 units, because we have to calculate the cost for 800 units. So 50 into 800, it is 40,000. Okay, next we have labor at 20. So 20 into 800, it is 16,000. Then direct expenses is 5 rupees. 5 into 800 is 4,000. First I'll make a note of it. So direct material 50 into 800, 40,000. Next we have direct labor, it is 25 rupees. So that's the reason I am writing 25 into 800, which is 20,000 rupees. 25 or 20, let's see. It's 20 rupees. So 20 into 800, I'm sorry, it is 16,000. Direct expense is 5 into 800, it is 4,000. Now we have calculated the direct expenses. Next we will see the overhead part. So overhead, they are telling that fixed overhead is 20, in that 60% is variable, which means 40% is fixed. So I will make a note of it. So fixed overhead, just give me a second. So fixed overhead, I'll be writing fixed overhead. We have fixed also, variable also. So fixed is 40% of 20,000. So 40% of 20,000. So 20 into 40. So it is 8,000 fixed. So 8,000. So variable is 12,000, but it is for 600 units. Now we have to calculate for 800 units. So 12,000 is for 6,000. So per unit I'll be getting 20 rupees. So if I make a working note here, so 12,000 is for 600. Now I want it for 800. So it will be 12,000 divided by 600, that is 20 into 800. It is 16,000. So that I'll be writing here. Fixed overhead is done. Now admin overhead is 15,000. In that 60% is fixed. So I'll calculate 15,000 into 60% is fixed, which means 9,000. Okay. Admin fixed is 9,000. Next variable is, so working note number 2. So 6,000 divided by 600 into 800. So it will be 8,000. Simple calculation. Okay. So it is 8,000. So did we leave anything behind? We'll check it once again. So we have taken the material cost, we have taken the labor, we have taken the direct expenses. Factory overhead is 60% variable, that is 12,000, and 8,000 we calculated for 800 also. That's it, we'll add it up. So 40,000 plus 16,000 plus 4,000 plus 8 plus 16 plus 9 plus 8. It is 1,01,000. So this is the manufacturing cost. Did they ask it per unit? Yes, they have asked per unit. So divide 1,01,000 divided by 800 units. You'll get 126.25. So that is the answer. So simple. So if you want, you can copy this. Okay, next we'll go to the third question. So third question is based on actually standard question, the ratios, the activity ratio, the efficiency ratio, the capacity ratio. Okay. So the factory produces two types of article, Y and Z. Okay, they are producing two articles. Y takes 8 hours. Okay, Z takes 16 hours. So for producing one article of Y, it is taking 8 hours, and for producing one unit of Z, it is taking 16 hours. In a month, that is 25 days into 8 hours per day, 600 units of X and 400 units of Z were produced. Okay, given budgeted hours is 800 per month, sorry 8,000 hours per month, and men employed are 50. Okay, now first we will calculate the standard hours, budgeted hours they have given, and we have to calculate the actual hours. So we will calculate that first. Actual is simple. See, Y and Z. Okay, So how much 1 unit is taking time? So 1 unit is taking 8 hours in case of Y and 16 hours in case of Z. 8 and 16 Y. Now we'll check how many units. 600 and 400. Okay. Now just multiply 8 into 600, that is 4800. 16 into 400, which is 6400. So you will be getting 10,200. This is the actual. Next, budgeted they have only given, which is 8,000 hours. Next we have to find the standard. Standard 25 days a month into 8 hours into 50 men. So this is the standard. So 25 into 8 into 50, which is 10,000. Now we have actual, now we have budgeted, now we have standard. Now we will directly jump into calculations. So first we have activity ratio. What is the formula? Standard hours by budgeted hours. So this is the activity, standard by budgeted. So standard we have 10,000, budgeted we have 8,000, which comes to 125%. Next we will calculate the capacity ratio. Capacity is nothing but actual hours by budgeted hours. So simple. So actual hours we have 11,200, budgeted hours we have 8,000. So 11,200 divided by 8,000 is 140%. Next we have efficiency. What is the formula? Standard by actual. Standard we have 10,000 divided by 11,200, which comes to 89.29%. So but in the question we don't have this option, but there is a small mistake, but the formula to calculate these ratios is this only. So if we have to know the concept, if there is something wrong, anyhow we will be getting the grace marks, but knowing the concept is very much important. So please do copy this. Now we will go to the fourth question. So fourth question is very simple. So given the budgeted output in the second quarter 8,000, in the first quarter fixed overheads were 40,000. So I'll write 40,000 is the fixed overhead, and variable overhead is 5 per unit. Okay, so 8,000 into 5. Okay, it is also 40,000. Next, semi-variable were 20,000, 60% 60% varying at 3 per unit. Okay. 60%. So in this question they have missed something. This 20,000 here 60% is varying at 3 rupees, which means 8 into 3 we have 24,000. Okay. 40 plus 40. So now in 20,000, if 60% is variable, what about the 40%? It is called fixed cost. So in 20,000, we have to take 40% as fixed cost. Okay. So if you add all this, you will get 1,12,000. So that is our answer. So if fixed cost is 40,000, variable overhead is 40,000. So 80,000 we got. In semi-variable, they are telling 60% is variable at 3 per unit. So in 3 into 8,000, because we want it for 8,000, so we got 24, and remaining 40% is fixed cost. So in 20,000, 40% is fixed, that is 8,000. So we'll be getting 1,12,000. So this is the answer. So now fifth one is the option is wrong, but we'll see what is the concept first of all. So ABC plans 96,000 units of TV in the first fiscal, which means first quarter, and 1,20,000 in the second quarter, 1,32,000 and 1,50,000 in third and fourth quarter respectively, and 1,56,000 in the first quarter of the next year. So 4 quarters plus 1 quarter of the next year. Given that at the beginning of the first fiscal, the company has 16,000 in stock. This is the opening stock. Please be careful. So opening stock is 16,000. Also at the end of the quarter, the company wants to maintain an inventory is equal to 1/6 of the sales of next quarter. So whatever you sell in the next quarter, 1/6 of it you have to maintain as closing stock in the previous quarter itself. Now example, if you take 6,000, if you are selling 6,000 in the next quarter, now you have to maintain 1/6 of it, which means 1,000. 1,000 should be as your opening inventory for the next quarter. So previous year closing stock, the previous quarter closing stock will be opening stock in the next quarter, no? That is the thing. So determine the units to be manufactured in the first and second quarter. Simple, we have to prepare the trading account. So fifth, the format is like this, no? Sales, we have to produce how much which is required for sales. Then we have to maintain the closing stock. So this is the total requirement. But we'll be having some closing stock. So we have to find it for first and second quarter. Okay, start. 96,000 is the sales for first quarter and 1,20,000 is for second quarter. Okay, 96,000, 1,20,000. And opening stock they have given us 16,000. Okay, accepted. So the closing stock, what they are telling, 1/6 of sales of next quarter, which means 1,20,000 into 1/6, that is 20,000. So 20,000 is the closing stock of first quarter, because it should be 1/6 of next quarter sales. So next quarter sales is 1,20,000. 1/6 is 20,000. That's it. So 96,000 plus 20,000, so it's 1,16,000 minus 16,000. So 1,00,000 is the total units to be produced. So that is the thing. Next, in the second quarter, we'll see. So second quarter sales is 1,20,000. Anyhow, we'll be having the opening stock, because last quarter closing stock will be opening stock of the next quarter. So this will come here, because closing and opening will be same. Now the thing is, we have to find only the closing stock. Closing stock is nothing but 1/6 of the next quarter sales. What is the next quarter sales? 1,32,000 divided by 1/6, which is 22,000. So second, we have to find it for second quarter. Now we have to see third quarter sales. So third quarter is 1,32,000. So 1,32,000 divided by 6. So it is 22,000. So 1,20,000 plus 22,000, which is 1,42,000 minus 20,000, 1,22,000. So 1 lakh and 1,22,000 is the right option. But in this they have given 10 lakh. So make it as 1 lakh, and this is the right answer. So if you want, you can copy this. So we have completed this. So we have completed all the 5 questions. Now we'll jump into the comprehensive one. So you can check the answers also. So here, before this, we have some MCQs and fill in the blanks, which is all theoretical part. So I will go through it and check only the we'll be solving only the important ones. If it is a minor one, please do cover it, because we have the answers also. So we'll invest more time on the practical part rather than the theoretical part. So because theory we have discussed in detail, so that's the reason. And the weightage of marks for theory would be less when compared to practical. So, but we have to not ignore theory part, but we have to know the theoretical knowledge. We have to know the concept. So what is flexible budget? What is this cash budget? What is this sales budget? What is this material purchase budget? What we will be doing in that? What is this zero based budget? And everything. So we have to know the concept and write it in the exam. So there is no need of writing line to line same as given in the textbook or the module. So that is not required. But the understanding of the concept is very much required here. So we'll solve with the first question. Comprehensive. First one is the flexible budget. When we are pro in it, we'll be solving all the questions on flexible budget, because it is very simple. In this, we have to know only the 3 concepts. One is the variable cost, one is the fixed cost, one is the semi-variable cost. Variable cost will be same at unit level, but it will vary in total, because per unit will be same. Whereas it will if we see the fixed cost, it will be same per total. In total it will be same, but per unit it will be differing. It will be going down if the number of units are increasing. Semi-variable, in this we will be having both the things, fixed component also, variable component also. First we will remove the variable component and the fixed component, and then the fixed component will be same, but the variable component will be changing as per the number of units. So we will be solving this now. So now, prepare a flexible budget for production capacity 80 and 100. Simple. We have to convert the present budget capacity into 80 and 100. So present they have given 5,000 units. So at 80 it will be 8,000 units. At 100 it will be 10,000 units. Raw material cost they have given, labor they have given, and direct expenses they have given. These are all variable expenses. Now factory overhead they are telling 50% is fixed. Here 60% is variable, which is nothing but the semi-variable expenses. So by using this, we have to calculate or prepare the budget for 80 and 100%. So very simple one. So in exam, always start from the right side. When you're having problems based on columns, please try to start from right hand side, so it will be having better presentation. So 100, 80, 50 and particulars. See, this way of presentation will be good now if you are starting from the right hand side. So first is the direct. Always write full forms. Do not write DL, DM, FOH for fixed overhead, VOH for variable overhead. Please write the full forms, because we know that DM is direct material. Who knows? The examiner may think it as direct message. That's the reason. So direct material. So at 50% it is 5000 as per the question. So at 80% it will be definitely 8000. At 100% it will be 10,000. I'm sorry, this is number of units. First is the direct material. How much is it? 80, 50. 80, 50. I guess this is 15 direct expenses. $80, 50, 15. Okay, done. Next, we'll start our labor work as usual. Multiplication into 80, which is 4 lakh. 50,000 into 50 is 2 lakh 50. 5,000 into 15 is 75,000. Okay, at 8,000 now. 8,000 into 8 is 6 lakh 40, I guess. Usual labor work we have to continue into 8,000 is 4 lakh. 8,000 into 15 is 1 lakh 20. So 10,000 into it is 8 lakh. Next 50 into 10,000 is 5 lakh. 15 into 10,000 is 1 lakh 50. So we have covered all the variable expenses. If you want in examination, you can give a total here as prime cost. If you don't want, you can ignore. There is no extra compulsion here. If you are giving a total, it will be good in presentation way. So now we know all the concepts. Now we are only concerned about the presentation. How good the presentation will be, that much more marks will be getting in the examination. Okay, next we'll jump into the semi variable. So fixed overhead is 50,000, in this 50% is fixed. Okay, so fixed overhead I am writing in short form, but you should write in full form. Okay guys, so fixed overhead. So on fixed part, one is variable part. So for this you can give a working note, that is 50,000, 50, 50. Okay, 50%, 50. So 50% is fixed, which means 25,000. Variable is 25,000, but we have to calculate it per unit, no, divided by 5,000, which is 5. So fixed is 25. I'll write everything. 25, 25, 25. Next variable is 5. So here it will be 25. At 8,000 it will be 8,000 into 5 is 40,000. 10,000 into 5 is 50,000. Done. Next, what is the overhead? Admin overhead. In that 60,000, 60% is variable and 40% is fixed. So 60,000 into 40%. So it's 24. Admin overhead. Fixed, variable. So 40% is fixed, which is 24,000. For this also you can do a working note, but not required here since you know this. So working note is compulsory. If you are doing working note, it will be an add-on. So 60% is variable. 60 into 36 divided by 5,000 is 7.2. Divided by 6,000. I'm sorry, 736 divided by 5 is 7.2 into 8000. 57,600 divided by so now I think we have calculated all the cost, fixed and variable and the semi variable, sorry. So we'll just add it up. 4 lakh plus 2 lakh 50 plus 75,000 plus 25,000 plus 25,000 plus 24 plus 36. So it is 8,35,000 here. Here it is 6 lakh 40 plus 4 lakh plus 1 lakh 20 plus 25 plus 40 plus 24 plus 57,600. So 13 lakh 06,600. Okay, next we have 8 lakh plus 5 lakh plus 1 lakh 50 plus 25 plus 50 plus 24 plus 72 16 lakh 21. So here we have completed the flexible budget, a simple one, but this can be asked by 5. They can ask for 5 marks. So they'll give variable also, they'll give fixed also, and they will give semi variable also, and then they'll ask us to calculate. So this can be a question. So please do copy this. So next we can see the next question. So next we have same thing. ABC Limited prepared a budget for 1 lakh units, okay, for one type of commodity. So raw material, labor, expenses, semi-variable, actual production was 60,000. So calculate the budgeted cost. So we have to calculate the budgeted cost. So same as flexible cost concept, flexible budget concept. So we'll be doing that. So one we have to find it for 60,000 units. Okay. And one they have given for 1 lakh units. Okay. And the particulars. So first we have the direct materials. What is direct materials? Then we have direct labor. Then we have direct expenses. So direct material is 2.52, 0.75 and 0.1. So just multiplication start. 2.52 into 1 lakh is 2,52,000 into 0.6 is 1,51,200. 0.75 75,000. 75 into 60% is nothing but 45,000. So why I did 60%? Because 60,000 is 60% of 1 lakh. No, that's the reason. 0.1 is 10,000. Here it is 6,000. So done. So if you want, you can give a total here. Next we have works overhead is 60% fixed, that is 2.5 per unit. So 2.5 into 1 lakh unit, which is 2,50,000 here. So in that 2,50,000, 60% is fixed into 0.6. So 1,50,000 is fixed. So what is the expense? Nature of expense? Works overhead. Works overhead, factory overhead, all are same. Works overhead we have two types. One is fixed, one is variable. So fixed is 1,50,000. 1,50,000. So it is 2.5 into 1 lakh for 1 lakh number of units. In that 60% is fixed. So 1,50,000 is gone. Remaining is 1 lakh. No. So which means 1 rupee per unit. So it will be 60 here. Simple calculation. If you want, you can give a working note here. So next we have admin. Fixed and variable. Fixed, how much is it? 80% is fixed, 0.4. So 0.4 is 40,000, I guess. Yes, 40,000. In that 80% is fixed, which means 32,000. So 32,000 is fixed here. Okay, variable here it is 8. So 8,000 divided by 1 lakh into 60,000, it is 4,800. So now we are calculating it for 1 lakh also, 60,000 also. Next work is done, I guess. Selling and distribution overhead. There also we have fixed and variable. Point 2. So 1 lakh into 0.2 is 20,000. 20,000, 50% is fixed. Okay, good one. So 10,000 is fixed here. 10,000 is variable here. So 10,000 divided by 1 lakh into 60,000 is 6,000 here. So add it up. We'll be getting the total amount. 2,52,000 plus 75,000 plus 10,000. So just add it up. So this adding is a pure labor job which we are doing. So concept wise we are done. So here it is 6,47,000 and here it is 1,51,000 plus 45,000 plus. Here it is 4,65,000. So that's it. So both questions are same based on flexible budget. Thing is we have to do the labor work. So please start the labor work. Please do copy. So flexible budget. So there are more chances of asking in exam. So please do copy. So next we'll go to the third question now. So actually the third question starts from here, okay? Please see that. So from the following data, prepare production budget for the company, stocks for the budget. So they have given opening stock, they have given closing stock, they have given the sales. Thing is, we have to prepare the production budget. So production budget is simple. For how much we have to produce, how much ever we sell. But there is also one more requirement, that we have to maintain some finished goods. No. So now if you produce everything and close it on 31st March, what you will sell in April 1st or April 2nd? Something which you have produced before. Now you cannot produce when the customer comes to the shop, and now you cannot tell the customer that please give me time, I'll produce, and you should have something in stock. That is the concept in production budget. So we have to produce something over and above the sales requirement, that is known as the closing stock. Now the concept in this question is simple. We have to produce two things. One is the how much ever we have to sell. So the sales we have to produce at 100% capacity. Next, we have to produce something more than sales also, that is called closing stock. So we have to produce two things, closing stock and the sales. But sometimes we will be having some opening stock also, which is leftover. So after taking into consideration all things, we have to produce the net number of units. That is, we have to produce sale and the closing stock. That is our total requirement. But we will be having some opening stock. So we will be deducting that. The net we have to produce. So that is the concept here. So we will go through the question now. So we have three goods A, B, C. So we have to produce sales at any cost because we have to sell it to the customer, no? But over and above we will be having some closing stock also. So this is our total requirement, but we will be deducting the opening stock which we have already there. So now we have the production. So this is the production budget. Okay, now we'll write down all the numbers 60, 50, 80. So the concept is important here. The other things just copy down. $60, $50, $80. So the closing stock $10,814. So it is $10,814. So here it will be 70. Here it will be 58. Here it will be 94. Now we will deduct the opening stock. Opening is 8, 9, 10. 8, 9 and 10. Have to reduce it. So it will be 84 here. It will be 49. Here it will be 62. So this is the production budget. So this much we have to produce at any cost. So please do copy. Simple question. So now we'll go to the fourth question now. So fourth question is also on the same lines. The tea manufacturing company has estimated its sales budget at 5 lakh units. Okay, they are telling that they'll have a sales of 5 lakh for the quarter ending 31st March 22. Okay, anticipated sales for January, February and March is 37.5%, 25% and 37.5%. So in a quarter they are selling 5 lakh units, but 5 lakh into 37.5% which is 1,87,500 they'll sell in January and March, and 5 lakh into 25%, which is 1,25,000 in February. Okay, the desired finished goods inventory are like this. So January 1, why did they give January 1? Because this is the opening stock. So please be careful here, and other things are closing stock. So this was one important thing, the opening stock. January 1st is the opening stock. So now we have to prepare a production budget. Please give a chance. So I'll be giving 3 minutes. Please try to solve. We have the opening, we know the sales, we know the closing stock, just we have to find the production. So please try. So even though it is a recorded class, please try to do. So please test your concept, or please try to give some work to the mind, so that we can so the same thing happens in the examination hall also. So please try. So Jan, February and March. So first we have to calculate the sales, then the closing stock, then the total requirement, then the less the opening stock. So then we'll get the production budget. Simple. Closing stock they have given 87,500, 93, 95. Just fill in the numbers, that's it. 87,500, 95, sorry, 93 and 95. Opening stock they have given, how much is it? 90. Here it will be 87,000 because the closing stock of previous month will be opening stock of next month. Okay, so here it will be 93. Okay, so sales we know now 5 lakh into 37.5%, which is 187,500. Here it is 1,25,000 because it is 25%. So just add and subtract and you'll get the answer. So simple concept, guys. Sales plus closing stock minus opening stock, that's it. So no big rocket science here. So just multiplication, addition and subtraction. So that's it. Question number 4 you can copy. Now we'll see the 5th question. J Manufacturing Company has estimated 2022 production requirements. Okay, so they're telling that production requirement is this much, April, May, June. Okay, the company wants direct materials ending inventory at 35% of next month production. So production they have given. Okay, so they're telling that production 1500 in April, 2000 in May, 2500 in June and 2800 in July, and they want that direct material closing inventory should be 35% of next month production. So your closing stock should be 35% of next month inventory, the material. So in April the closing stock should be 2000 into 35%. 700 should be your closing stock of April, because see the line tells that 35% of next month production. So if you are producing 1000 in the next month, 350 should be as the closing stock of raw material in the April month. So that's it, very simple. So the price per unit is 20 and it takes 1 unit of direct material to produce 1 unit of finished goods. This is 1 to 1. Please be careful. In exam they will give 1 unit may require 2 kg. Then you have to multiply for direct materials. Okay, this is the number of units in finished goods. So for 1 finished goods we require 1 kg. There are chances that they may ask for more than 1 kg also. Please be careful. Prepare a direct materials purchase budget for the second quarter. That's it. So second quarter here refers to they are following the calendar year. So April, May, June. April, May, June will be second quarter. January, February, March will be first quarter. So now we have to prepare it for April, May and June. So total requirement will have 2 things. One is the production, which should be issued to the production, and the closing stock, but we'll be having some opening stock now. So that is the thing. Same as sales budget. Please do start. We'll be doing it. I'll give 2 minutes. So please analyze how the question should be done. So after that we'll be doing. So this is material purchase budget. Material purchases budget. So please give an heading to all the questions. Okay, this is also important in examinations. So production requirement, closing stock is 35% of next month production. So this is our total requirement minus the opening stock. Done. So first we'll note down all the production: 1500, 2000, 2500, 1500, 2000, 1500, 2000, 2500. So closing stock is simple. Just take 35% of next month production. So 2000 into 35. Here it is 700 because closing stock will be 35% of next month's production. So here it will be 2500 into 35%, 875. For June we have to see for July's production. July production they have given 2800 into 0.35, 980. Done. So this is our total requirement. But there is one catch here. How will you calculate the opening stock of this? So opening stock will be closing stock of last month. You understand the concept? So opening stock of current month will be closing stock of last month. So closing stock of last month, what is it? 35% of next month sales. What was the next month sales? 1500. So this opening stock of April will be closing stock of March. Understood? So closing stock of March will be opening stock of April. So this is the concept we know. So the closing stock of March will be 35% of April month production. I repeat once again. Closing stock of March will be 35% of April month sales because they have given the question. So 1500 into 35% is 525. So for this we will prepare a working note, don't worry. 1500 plus 700, 2200 minus 525, it is 1675. Here it will be. So opening stock, here closing stock means here opening stock, here closing means here it is opening. Just add and separate. 2000 plus 875, 2875 minus 700, it is 2175. 2500 plus 980, 3480 minus 875. So this is the number of units of raw material. If you have the cost, we can multiply it by cost now. Cost is 20, no? Just multiply it by 20, that's it. So the units to be purchased actually. So this should be purchased at the rate of 20. Just multiply 2605 into 20, 52,100, 2175 into 20, 43,500, 1675 into 20, 33,500. So these are the calculations for material purchase budget. So you can copy this. Now we'll go to this next question. Sixth one. The sales manager of MR Limited. The sales manager of MR Limited reports that the next year he anticipates to sell 50,000 units of a particular product. So he's telling that he'll be selling 50,000 units. Okay, boss, done. So the production manager consults the storekeeper and casts his figures as follows. Two kinds of raw material, A and B. Each unit of product requires 2 units of A and 3 units of B. So now you are producing one product. Let we name it as Z. So Z requires A and B both. A 2 units, B 3 units. Okay, done. The estimated opening balances at the commencement of the year. So finished goods we have 10,000. So raw material of A we have 12,000 and B we have 15,000. Then the closing stock also we have. So first we have to prepare production budget, then we have to prepare material purchase budget. So we have to prepare both the things. So the formula remains, or the concept remains the same for both the production and the sales budget. So first we'll prepare the sales, then we'll come down to production budget. Then we'll come into the material purchase budget. Now they have only given the sales, which means there is no requirement of sales budget. Now we have to do only the production budget. So production budget, what is the formula? Sales plus closing stock minus opening stock. That's it, of finished goods. Please remember that. So here he anticipates a sale of 50,000 and he requires a closing stock of 14,000 as per the question, but he is having a opening stock of 10,000, which means 54,000 is his requirement or the production. Then multiply it by 2 in case of A, 3 in case of B, and then find the material purchase budget also. Please try this question. I'll give 4 to 5 minutes, then we'll solve it. Then please we can cross check the answers. I'm sorry, sixth one. So first we have to prepare the production budget. So the formula is sales plus this closing stock, total requirement minus the opening stock. So sales, it was 50,000 plus 14,000 of closing stock, so 64 minus the 10,000 of opening stock, which is 54. Okay, but there is a twist here because they require two materials, A and B. So A, for 1 unit of output they require 2 kgs of A, so it is 2. Here it is 3. Here, so it will be 108 kgs. Here it will be 54 into 3, which is 1,62,000 kgs. So now material purchase budget, simple. For A and B particulars. So material purchase, first we have to issue for the production. So production requirements. So production requirements is 108 kg, 1,62,000 kg. Next we require the closing stock to be maintained, because if there is any unexpected demand we have to serve it, no, that's the reason. So closing stock is 13 and 1. So 13 kgs and 1000 kgs. So here it is 108 plus 13, it is 1,21,000 kgs. 1,21, here it is 1,63,000. So less the opening stock, here it would be 12 and 15. So it is 1,21,000 minus 12,000, 1,09,000 kgs. Here it is 163 minus 15,000, 1,48,000 kgs. So we'll see if there is any price given for this. No, they have not asked the price. So we have completed the question here. So please do copy. So simple one. First we'll prepare the production budget, then we'll prepare the material purchase budget. That's it. Next we'll go to the next question. So this question number 7 is same as illustration 7 also. So both are related to sales overhead budget. So the following expenses were extracted from the books of Messrs. AB and Sons, and you are required to prepare sales overhead budget. So they have given some of the fixed expenses, that is advertisement to radio, salary to admin staff, television, sales force, rent of the building, etc. Then they have given the variable, which is carriage outward, which is 5% on sales, commission at 2%, and agent commission at 6.5%. They have given the sales also. Next we have to prepare the sales budget. So we'll prepare it. So here we have two types of sales. One is 80 lakh and 1 lakh. So first we'll write on all the fixed expenses. What is the first fixed expense? Advertisement to radio, television. Advertisement to radio. Then television is 12, admin staff salary is 20. Okay, sales force is 15,000. Salary to sales force. This is admin. Next we have salary, sales force, which is 15,000. Next we have rent at 5k. Here we can give a total 2,000 plus 12,000 plus 20 plus 15 plus 5, 54. So both the ways it will be 54 because it is a fixed expenses. Now we will come to variable. So first variable expense is which one? Carriage outward. Carriage outward. How much is it? 5%, I guess. 5% on sales. So 5% on 80,000 is 4. 5% on 1 lakh is 5. Next we have sales commission and agent commission. Here we have an important point, okay, agent commission. So anyhow we have agent sales, we'll just multiply with it. Agent sales is 8,000 into 6.5%, which is 520. So agent commission is easy, 6.5% on agent sales. So agent sales here it is 10,500 into 6.5%, 682.5. please take it as 683, round off. Sales commission, if you remember that question, sales commission was only the difference between the total sales and the agent sales. So now here we have 80,000 sales, but in that 8,000 is done by agent, no, so there is no requirement of paying extra commission on that also. So on 72,000 we have to pay 2% because the remaining part we are paying agent commission. So here it will be 1440, and here it will be 1 lakh minus 10,500 of agent sales into 2%, 1790. That is the sales commission. So that's it, guys. Finished. So 4,000 plus 14400 plus 520, which is 5960, plus 54,000, which is 49,960 is the total overhead. Here it is 5,000 plus 1790 plus 683 7473 plus 54,000 61,473. So this is it. So we have completed that question as well. So please do copy. So now we will go to the next question. So 7 we have done. So 8th again is a flexible budget question. The expenses for the budgeted production of 10,000 units are furnished below. Prepare budget for 8,000 and 6,000, that is 80% and 60%, and they are telling that admin expenses are fixed at all level, which means it is a fixed cost. Okay, please try this out. Simple one. So I'm just writing down all whatever they have given in the question, that's it. So direct material, so 70 rupees. 70, labor is 25 and variable overhead is 20. 70, 25, 20. $70 into 10,000 is 7 lakh. So this one will be easy. Just multiply it by 10,000. So 2 lakh 50. 2 lakh. That's it. Here 70 into 8,000, which is 5 lakh 60. 8,000 into 25. 8 lakh into 20 is 1 lakh 60. So 6,000 into 70, 4,20,000. So direct material, direct labor, variable overhead we have completed. Next we'll see what is it. So fixed overhead 1 lakh they have only given. Okay, done. Fixed overhead I'll first write it down. So please write full form in examinations. 1 lakh, 1 lakh and 1 lakh. Fixed overhead is done here. Next we have variable expenses. There it is 5 rupees. They have only given. Okay, variable overhead is 5 rupees. So variable overhead is 5 rupees. 5 and which means 50,000, 40,000 and 30,000. So that is it. We have done the variable also. Next we have other overhead also. No. First I'll write admin because admin is fixed overhead. Then selling we have, distribution we have. So first I'll write down admin. 50,000 is fixed. So selling overhead we have both things, fixed and variable. No. Distribution also we have fixed and variable. So selling overhead they have given 5 rupees for 10,000 which is 50,000. In the 10% is fixed, so which means only 5,000. So 5 rupees is variable. So I'm sorry. So selling here is 13 rupees. Sorry, 13. So I'm sorry. So 13 into 10,000 is 1,30,000 into 10% is 13,000. Okay, I'm sorry here 13,000. So remaining will be obviously variable. So first I'll write down all the fixed expenses. Okay, so 1,17,000 is for 10,000 units. Now we want it for 8,000. 8,000 is 93,600. For 6,000 it is 7,200. So that's it. We are done here. So next we have only one, which is distribution. 17 into 10,000, 70,000 into 20% is fixed, which means 14,000 is fixed here. So 14,000 is fixed. So here it will be 56. So 56,000 divided by 10,000 is 5.6 into 8,000, which is 44,800. Divided by 8 into 6,000, which is 33,600. So now almost we have covered everything, I guess. Total admin expenses, everything covered. So just add it up. Plus 2,50,000 plus 2 lakh plus 1 lakh plus 50 plus 50 plus 13 plus 1 lakh 17 plus 14 plus 56. 15,50,000. Okay, now for 8,000, 5,60,000 plus 2 lakh plus 1 lakh 60 plus 1 lakh plus 40,000 plus 50,000 plus 13 plus 93,600 plus 14 plus 44,800, which is 12,75,400. 12,75,400. Next we have 4,20,000 plus 1,50,000 plus 1,20,000 plus 1 lakh plus 30,000 plus 50,000 plus 13,000 plus 7,200 plus 14,000 plus 33,600. So 10 lakh 800. 10 triple 0 800. So simple. Please do copy this. So if you want, we can make a working note also for this semi-variable thing. Doing working note will fetch us extra marks. So please try to do working note for that also, for bifurcation of fixed and variable. So that's it, we can copy. So now we'll see the next question based on flexible budget itself. So question number 11. So 11 is a very easy question, please try. Here we have to find it for 7 and 9,000. So that's it. So we'll start off directly. So 7 and 9, 9,000 units, 7,000, 10,000 particulars. So we'll see what are the expenses in it. Direct material, direct labor, variable overhead, fixed overhead, variable expenses. Same as the previous question. No single difference. Same. Then we'll go with the full flow here. 48, 24, 20. I'll just copy this. Selling expenses, admin, selling, admin, distribution. Which is the fixed, only fixed expenses? Admin. I think we can start it off. 48, 24, 20. So fixed overhead is 1,20,000. Variable is 4 rupees. Just we'll start the multiplication now. So 10 lakh into 48 is 4,80,000. 2,40,000. I'm just multiplying, that's it. 2,40,000. Here 7,000 into 48, 3,36,000. 9,000 into 48. One lakh 47,000 into 20 is 1,80,000. We have done till here 7,000 into 4, 28. Here it is 36. Okay, now we'll start fixed and variable. Fixed and variable. So we can do a working note also for this. Selling 10% is fixed, 12 rupees. 12 into 10,000, 1,20,000. In that 10% is fixed, which means 12,000. So 12,000 fixed here. It is 1,08,000. So 1,08,000 divided by 10,000 is 10.8 per unit into. So fixed part is 10%. That I'll write it down. So 10.8 per unit into 7,000. 75,600 into 9,000, which is 97,200. Done till here. Admin is totally fixed as per the question. 40,000 is fixed. So I'll write 40 everywhere. Then distribution. 20% is fixed. So 10,000 into 40. I'm sorry, 10,000 into 4 is 40,000. In that 20% means 8,000. 8,000 is fixed and 32 is variable. So 8,000, I'll write it down. 8,000 and 32 here. So 32 means 3.2. So 3.2 into 7 and 9. So 22,400. $28,800. That's it. We have completed all. Just add it up. 4,80,000 plus 2,40,000 plus 2 lakh plus 1,20,000 plus 40,000 plus 12,000 plus 1,08,000 plus 40,000 plus 8,000 plus 32,000. So 12,80,000 for 100% capacity. For 70% it is 3,36,600 plus 1,68,000 plus 1,40,000 plus 12 plus 28 plus 12 plus 75,600 plus 40 plus 8 plus 22,400. 8,42,000. 336 plus 168 plus 1,40,000 plus 1,20,000 plus 28 plus 12 plus 75,600 plus 40 plus 8,000 plus 22,400. So 9,50,000. Here it is 432 plus 2,16,000 plus 1,80,000 plus 1,20,000 plus 36 plus 12 plus 97,200 plus 40 plus 8 plus 28,800. So 11,70,000. So simple guys, simple budget, flexible budget only. We have done 4 problems. That's the reason I told you it may be expected in exam. So that's it. So please do copy. So 11 is done. Now we'll discuss 12. So 12 is a easy one, we'll discuss it off. The profit for the year of Push on Limited works out to be 12.5% of capital employed. Okay, and relevant information they have given. So sales is 5 lakh, direct material is 2 lakh 50, labor is 1 lakh, variable overhead is 40,000, capital employed is 4 lakh. So first we'll find out the profit. So 4 lakh into 12.5%, so which is 50,000 is the profit. So why did I calculate this? In this they have not told about the fixed overhead. Please be careful. That I have found out here. How 5 lakh minus 2 lakh 50 of direct material, 1 lakh of direct labor, 40,000 of variable overhead, and profit we have 50,000. So 60,000 is the fixed overhead here. So this they have given to find out the fixed cost, that we have found out. So we'll see what is the next question, what they are asking actually. The new sales manager who has joined the company recently estimates for the next year a profit of 23% of capital employed. What is your profit? 4 lakh into 23%, which is he is expecting a profit of 92,000. Okay. And provided that the volume of sales is increased by 10% and simultaneously there is an increase of selling price. Sales is also increasing and price is also increasing, 2 times increase, and then overall cost reduction in all the elements of cost by 2%. So there is a reduction in the cost. Fixed cost definitely it will not come down, only variable cost will come down. Please be careful about that. So that's it, we'll calculate. As usual, income statement, sales, be careful. So there are 2 increases in sales. How? 5 lakh into 10% the into 110%, because 10% is volume increase and 4% is the price increase. So we have to take it as 2 times. So 5 lakh into 110%, which is 10% increase in the volume and 4% increase because it is increasing in the price. So price sales will be 5,72,000. So variable cost, how much was it? I'll just add it up, all the variable cost together. Okay, so 2 lakh 50 plus 1 lakh plus 40,000, 3 lakh 90, but there is a reduction of 2%. So 3 lakh 90 into 98%, because there is an increase, sorry, decrease, into 0.98, which is 380 to 200. So fixed cost is as usual 60,000 as calculated. So now we'll arrive at the profit. 572 2000 minus 382 to 200 minus 60,000, which is 129,800. How much is it? 129,800 divided by, so 129,800. Actually we expected 92,000 because 23% of 4 lakh, but we are getting more than that. No, then it is find out the computing cost and whether proposal is can be adopted. Obviously it can be adopted because we are getting more than the expected profit. No, that's the reason. So question number 12 done. So in 10th question there is a problem. Okay, they have not given the production, so that we'll find out and check in the next sessions. So we are left out with question number 9 then. So question number 9 is very typical and we have to make a what do you tell, a assumption, then we have to proceed with it. So please read the question once. So this will be the last question for the day. Please read this. So now we'll read the question. A company manufactures product A and product B. Okay, there are two products during the year end for December. Okay, it expected to sell 15,000 kg of product A and 75,000 of product B. So they are telling that they will sell 15,000 of product A and 75,000 of product B. Okay, then at 30 and 16. Okay, the direct materials P, Q and R are mixed in the proportion of 3:5:2. So for PQR, there are three materials which will be mixed in the proportion of 3:5:2 for A and 1:2 of Q and R in B. So this is the most important point here. The actual and budgeted inventories are given. So opening they have given, closing and anticipated cost. So here we have to find only one thing. What is that? For A, we have three materials P, Q, R, and it is in the proportion of 3:5:2. And in case of B, Q and R is in the proportion of 1:2. But they have not given how much kgs it is used for one unit. So that is the problem here. So now we'll make an assumption that it will take 1 unit 1 kg. So that is the assumption I am making here. So PQR they have given, opening stock, closing stock they have given. They have to prepare the production budget and material budget. Material budget is nothing but the material cost. Okay. Production and the material budget. So it's easy. So first prepare production budget. So question number 9. So production budget for A and B. As usual, same formula, sales. Then we have closing stock, the total requirement minus the opening stock. Okay. So sales obviously they would have given in the question. Closing, opening, opening and closing stock they have given. Opening is 3 and 4, closing is 1,500 and 4,500. Opening is 3 and 4. Closing is we'll read the question once again clearly. So first is opening, then we have closing. Opening is 3 and 4. Okay. So 3 and 4 is opening stock, and 1,500 and 4,500. 1,500 and 4,500. So we'll see what is the sales here. Sales, how much is it? 15 and 75. Okay, so 15,000 plus 16,500 minus 3,000. So 13,500. Here we have 75 plus 4,500, 79,500 minus 4,000, which is 75,500. So this is the requirement. Now material purchases budget is easy. So for product, this is PQR, I guess. So for product A, PQR is in the proportion of 3:5:2. So 13,500 divided by 10 into 3, 4050, divided by 3 into 5, 6750 is the 3:5:2. In that ratio we have to divide. Okay, simple. For A done. For B it is 75,500 divided by 3 into 1:2. So 25,167 50,333. So this is the requirement. So this is the production requirement actually. Add closing stock to this, subtract the opening stock, that's it. It will be given in the question. So closing stock is 4 and 3, 4, 3 and 30. 4, 3 and 30. Closing stock, opening stock 3. Okay, sorry, this is opening. Anticipated closing stock is 369. 369. So just subtract this. So that's it. We are done with the question now. We'll check once again. 1575 is the sales. Let's see, 30 and 16, and just multiply with the cost. You'll get the cost also. Okay. Then A sales 15,000. Expected closing stock is 1,500 minus. So you can copy this. So this would be the end of this session. So here we have completed all the questions of budget and budgetary control. Next, in the next class, we will see standard costing or ABC. So you can copy, and I'll close this session. Thank you.